because in 2007, I went through a not so nice divorce from my starter husband. And I know I love that term, starter husband. While I was going through that divorce, I tried to qualify for a mortgage on my own, and I was a mortgage broker and couldn't get myself qualified. And it was disheartening and awful. And I felt that there needed to be a better way. So I really started researching options. I found out that there was an actual federal government program that is designed for people going through relationship breakdown that no bank ever told me about.
Welcome to Access to Justice. I'm one of your hosts, Heather Malarick at Merrick Law, and I'm joined today by my co-host, Evan Clark from Kahane Law. Hey, Evan, how's it going?
It's going great, Heather. I'm just enjoying this beautiful, cold sunshine. Of course, by the time people hear this, it might be even warmer, so that'll be nice. How are you doing?
I'm well. Yeah. Same thing. You can go outside and get sunburn and frostbite at the same time at this time of year, right?
And we're just about to start lockdown number 3. How do you feel about that?
I hope it's the last one. That's for sure. I'd like to see an end to this. I'd like to see my family and my friends again. But yeah, I'm optimistic, cautiously optimistic.
I share your hopes.
Yeah. Nothing to do but be hopeful, I guess. We're also joined by our very special regular guest, Kim McDonald. Hi, Kim. How are you?
Hi, Heather. Thanks for having me on today.
It's always a pleasure to have you on, Kim.
Always a pleasure. So we're also joined by a very special guest, Krista Lindstrom. So Krista is a certified collaborative financial neutral. She's also a licensed life insurance broker and a mortgage broker. And she started off her bio that she sent us with, I love, all caps, my work as a mortgage broker. And I love talking to people that love their work because they're so passionate about it. And I know that Krista is one of those people that's passionate. So I'm really excited to ask her questions today about her work and share some information with our listeners about the world of mortgages. Hi, Krista. How are you doing? Thank you. Thank you for joining us and welcome.
Thank you so much for having me. I was kind of laughing when you said sunburn and frostbite at the same time, because if you look fairly closely, I have wicked sunburn right now because I went skiing on Monday. I played hooky from work and went skiing on Easter Monday and didn't put sunscreen on. Goofball move, I know better. And I've got this really nasty sunglass burn right now.
It's very prestigious, actually.
I got natural color to my face right now.
It used to be back in the day that it was prestigious to have zero color, right? And you'd walk around with a parasol.
Yeah.
Only the low class workers had suntans. But now it's flipped, so you're good.
Yeah, there we go.
Yeah, a sign of being able to live a life of leisure and enjoyment. Yeah. You're a real outdoor adventurer too. The last time you and I chatted, you were talking about the sled that you bought.
Oh yeah.
Which apparently is also what a skidoo is called. But people that are serious about it call it sleds, is from what I understand. So
yeah. My husband and I are mountain snowmobilers. So I got a new to me sled this year. It's a Skidoo 850, which is it has a ton of power. I will say that it's winning the battle in between me and it right now. I fall off a fair bit because it's fairly tippy. But I assured myself that I will get better. And I'm super excited to be able to ride that sled up in the mountains. My goal is to keep up with all the boys up there. So I'm a bit of a tomboy at heart.
So you just like hurdle yourself around on a machine up and down a mountain.
Well, okay.
I mean, that sounds like a blast, but it sounds terrifying.
The most majestic part about it is, when you're on top of the clouds and on a mountain peak and being able to be above and look down and have all the clouds below you and have the sun shining. And there's just something about that feeling that I can't replace with anything else. So when you're up there, it's pretty peaceful. But I've learned that I'm a bit of an adrenaline junkie. I like feeling scared. I like that full horsepower feeling. And I get that snowmobiling for sure. So that's just who I am.
What kind of car do you drive?
Oh, a Honda Civic. Nothing special.
It could be like a souped up Honda Civic.
Well, it is a turbo. Yeah, it is. But I've learned not to drive very fast in my car because my husband threatened to put photo radar tickets into our monthly budget. So that's not cool, paying photo radar all the time. So I set cruise control everywhere I go now.
You know what? I do that too. And that's kind of a new thing for me as well. Like I one day I just decided, how about I just set it on cruise control and I'll just take deeper breaths on my commute. And I actually set it for the speed limit itself, which is slower than everyone else is going.
Right.
But that way I'm never like, worried, wait, were those lights that just flashed as I went through the intersection for me or for the guy next to me?
Right.
Like I have a clean conscience as I drive around the city.
Yeah, so you're right. Heather, snowmobiling and sleds are one and the same. Just most people don't take it to the extent that we take it, but there is definitely a crowd out there that does. So fun. You should really try it sometime. It's a lot of fun.
Sounds amazing. Well, maybe I'll come join you one of these days.
Yeah, I'll borrow you my Avi gear or avalanche gear and you could go on up and enjoy.
Ooh, well, it just got me feeling a little scared and nervous, but variety's the spice of life, right? And why not live on the edge a little bit? So,
Fair enough.
Okay, so you're a wild adventurer mountain gal, but you're also a mortgage broker. So maybe you can start and tell us a little bit about your qualifications, what you do.
Sure.
When you're not
I've been a mortgage
racing
broker.
up and down mountains.
Oh, sorry. I've been a mortgage broker for 16 years now. I love being a mortgage broker. I find it incredibly interesting. I'm kind of one of those people that's a bit of a geek when it comes to, I like following the economy. I like following economist reports. I like reading what the Bank of Canada does. I just really like stuff like that. So my work isn't really work to me. And I really enjoyed math in high school. I got a math scholarship in high school. So I'm fortunate that kind of comes easy to me. And I was really looking for an opportunity to be able to be self-employed. I was a young mom when I became a mortgage broker. I have 2 adult kids that I'm super proud of now. And this was a great way to be able to work from home and be a mom. And it's just turned into this amazing career. I changed the specialty of my mortgage brokerage to divorce maybe about 5 or 6 years ago, because in 2007 I went through a not so nice divorce from my starter husband, and I know I love that term, starter husband. While I was going through that divorce, I tried to qualify for a mortgage on my own, and I was a mortgage broker and couldn't get myself qualified, and it was disheartening and awful, and I felt that there needed to be a better way. So I really started researching options. I found out that there was an actual federal government program that is designed for people going through relationship breakdown that no bank ever told me about, or that I never knew about, and I've learned the ins and outs of that into great detail now, and specialize in that particular program. And it's actually really rewarding to see people who are now on their own and being able to own their own house and have financial independence from their ex-spouse. I love that part of it, the success of people being able to do things on their own, especially the ones that were heavily reliant financially on their other spouse. The power that comes with that is wonderful to see. So I went and got my life insurance brokering license about 3 or 4 years ago, because there seemed to be a natural need there for people who are getting mortgages to do life insurance. I don't do complex cases at all. I refer those out, but basic life insurance I do. So I use all those designations together with, and then I became obviously the same thing as I think both Heather and Kim, trained collaborative professional, to understand those sides of, I think there's a better way to divorce rather than litigating. And I really like working with those couples who are trying to do the best for their family, despite the fact that their marriage is no longer working. So I like all of those combined.
Wow. So I think what you talked about there for the whole, your experience of not getting being able to qualify for a mortgage when you're getting divorced, I'm really excited to hear what you have to say about that and that program, because I'm sure Heather already knows about it, but I don't know about this program.
Okay, we can talk about it.
Yeah, well, let's do it. And I'm excited to learn about that. So, that's something I can tell my clients, because it's very common, right? Like, people go from joint incomes, and usually one person's making more than the other. And now one person's going to take the home, and maybe it's the person with the lower income. Regardless, they can't get approved to refinance it. So I think that scenario is super common. So I'm excited to hear what you have to say about that. And I thought it was interesting that you got your LLQP, your life license, and smart. So when I was back in another life, in my late teens, early 20s, my dad had a financial planning business that I worked with my brothers in that business for a little while. And so I have a little bit of background in that area, and they were, they're selling life insurance and financial products. And so I think that's something that's great, because so many people, when you get the mortgage from the bank, and the bank's like, hey, you want life insurance? And they're like, yeah, it seems like a great idea. But it's terrible insurance that goes down in value as you pay down your mortgage. And so what a great thing to be able to offer, hey, and by the way, don't get the bank's insurance. I can offer you this insurance product that's much cheaper, and we'll do something even better than what you're doing. So I think that's pretty cool that you did that.
I'm sure Kim probably has an LLQP as well. Is that right, Kim?
Yeah, that's correct.
Yes, and you're probably way more trained in that area than I am. I just do kind of the basics. But the main driver to that, Evan, was my very first year of mortgage brokering. I was working with I was learning mortgage brokering, and I had taken over a file from another mortgage broker that they had sold MPP, so Mortgage Protection Plan, which is a creditor insurance program that people think that they have life insurance. And in that particular case, it was a husband and wife and 2 small kids. The wife stayed at home. The husband was in his 30s, and he was a finishing carpenter. He was finishing cabinets in somebody's home, and he fell dead on the floor of somebody's home. Well, what ended up happening is he had the MPP coverage, but MPP ended up subpoenaing his health records back to his birth. And the reason that they did that is there's 4 health questions on a MPP, on a creditor application. There was 4 health questions, and they determined that he had lied on his application. So they were looking for an opportunity to decline the coverage. When he was in high school, he had a racing heart when he played football. So they said because he'd talked to the team doctor about his racing heart, that he lied about the pre-existing heart condition, and they declined the coverage. And from that day forward, I swore to God I would never sell MPP, because I never wanted to ever have to tell a widow, of a mother of two that she didn't have the coverage that they thought that they had. So
That's terrible.
creditor insurance is horrible. Anyway, next topic.
Yeah, I mean, if anyone didn't know, insurers love to not pay.
True. They look for ways to not pay.
Yeah.
Yeah.
And so the insurance products that you sell now, that kind of thing is not going to be an issue.
Correct. Guaranteed to pay now because we underwrite your health ahead of time. Right, Kim?
Correct. The last thing you want is to put something in place and then something goes wrong, and that's the time that they start looking at the questions and the answers, and that's when they decide whether they want to issue this policy. So like Krista says, it's much better to have, I call them the goblins. The little goblins look at your policy ahead of time and try and find problems with it. And once they stamp that approved, then you're pretty good. You're pretty good to go.
Yeah, and also not that that guy did, but don't ever lie on your insurance application, because what happens is you get a refund of premiums.
Yeah, that's it.
Yeah, that's it.
When a good insurance advisor would make sure that doesn't happen. So there's a difference between having somebody who's not insurance licensed selling insurance versus somebody who is insurance licensed selling insurance. You're going to get better guidance along the way.
For sure.
Yeah. But yeah, that's interesting. So yeah, he would have just been answering those 4 questions on his own. It's not one of those things where he's, they're talking to his doctor or doing more of an investigation. So it was probably just a sort of innocent oversight type of thing, right?
Yeah.
Yeah,
9
that's
months.
tragic.
9 months is how long they investigated his health for before they declined the claim. So they sat in limbo for 9 months, not knowing. In this particular situation, the wife that was left had 2 sets of parents, like her husband's parents and her parents, that could help out. So it wasn't horrific. I mean, obviously it was horrific. Her husband died. But, from a financial standpoint, both sets of parents chipped in and helped out. But gosh, I don't want anybody to ever be in that situation again.
Yeah, especially to be relying on something like that. So, okay. So the spousal buyout program, Evan, I'm glad that you thought that I knew all about it, but all I know about it is to send people to Krista. So I'm actually really excited about Krista's answer of what the spousal mortgage buyout is as well. So maybe you can tell us about it.
Okay, great. So the spousal buyout program is actually a federal program designed for individuals who are going through relationship breakdown. So if we compare it to a refinance, it has to do with equity inside of your home. So under the spousal buyout program, you can access 95% of the equity inside of your home. And why that's important, especially here in Alberta, is we have not seen property values rise in the past 10 years. So people who bought with 5% down probably still only have 5% equity inside of their home. Actually, probably 2 because they had to pay the CMHC premium. But anyway, so the spousal buyout program allows in situations of relationship breakdown. So specifically relationship breakdown. So it can be a married couple, a common law couple, even like if a brother and sister own a home together and had a falling out in relationship, they can access 95% of the value of their home to be able to remove one person from the title. How that differs to the typical refinance, like if you were going to go to the bank, is how that differs is the bank requires you to only finance 80% of the value of your home. So you can access 15% more equity instead of leaving 20% equity inside. So that's the main difference there is lots of people get declined because they don't have enough equity inside of their home when they go to the bank. And that's why this is really important is you can access, an additional 15% of funds. What's also really cool about the program is you can, providing that there's enough equity, not only can you remove the mortgage from your ex-spouse's name if there's a joint debt. So maybe you have a car loan or a credit card that's considered matrimonial debt. You can include that in the transaction. Or maybe one of the spouses has an equity requirement. So maybe when let's say there's $20,000 in equity and they want to divide that 50-50, $10,000 to one spouse, 10 to the other. It allows for an equity payout of $10,000 or whatever it is that the lawyers decide is the equity payout. So it allows that to happen. We can include legal fees inside of that. So providing all of this is itemized in the minutes of settlement, because one of the terms and conditions of this mortgage is signed minutes of settlement. So providing we say payout, for example, Scotiabank joint visa of $20,000, we can include that in the proceeds. So I've become a really good coach, in saying, this will work if we do this and this and this. And then I actually coach the lawyers saying, could you please itemize these things, in the minutes of settlement in order for this to proceed? And we've had a lot of success with it. And so it's very helpful because I think it's really important to not keep couples financially tied to each other as they go through divorce. Financial independence is really important because although you might be semi getting along right now, I always find if you're financially tied, things go wrong really quickly, and you don't want to be able to, adversely affect, somebody else's credit because you're still financially tied to each other. So the most common people who use the spousal buyout program are generally people who have children and they want to keep them in the same neighborhood. They don't want a big upheaval, for the kids. They generally, want to keep the same neighborhood friends for the kids. They want to, keep walking distance to the school or whatever it is. So that's why we see a lot of people doing the spousal buyout program. That's what's best for the family, typically speaking.
Okay.
So it's a really good program. I really like it. One thing I will note, it is a CMHC. Well, in Canada, we have 3 insurers, CMHC, Sagan, and Canada Guarantee. So one of the things that I do like to bring to your attention is it is an insured program. So if you hadn't, we can transfer the CMHC premium over in most cases. But if you hadn't previously paid the CMHC program, we do have to include the CMHC premium. So that's something that may need to be negotiated if a lawyer is watching this, or a financial planner or putting those numbers together. We do have to consider the CMHC premium on this.
Okay.
Does that answer your question? Do you understand that it's an extra 15%? Is that clear?
Yeah. So I think maybe I have a question to ask for our viewers potentially. So when you're talking about equity, you're talking about the value that's in the home. Is that right? So maybe can you define that in that was an assumption on my part that everybody knows what equity is.
Equity is the difference in between the value of your home versus how much you owe. So if the value of your home is $300,000 and you still have $250,000 worth of mortgage, the difference in between $300,000 and $250,000 is $50,000. That's your equity. And typically it's split in some way, shape, or form. I really leave that up to the lawyers to decide because, sometimes there's other circumstances there why it wouldn't go 50-50. But that's something that I leave that to you guys, and you guys tell me how much the equity payout should be to the other spouse.
Right.
Yeah, it might be helpful to just explain that when it comes to property division, generally the property as a whole, and so not just the house, but whatever other property, like your sleds, for example, all get thrown into a pot, so to speak, and for the division of the value of the whole thing. It's a holistic thing. So that can look like a number of different things. For example, there could be other investments that if one person's keeping the house and the other person's keeping investments, and that kind of can balance out the value of the house. Yeah. So it doesn't necessarily mean you have to split the equity of the house 50-50. But it's not infrequent that the house is the only or the main asset. And so you can see how that being able to access that extra equity would be so important, especially for people that don't have a lot of assets. And also I just wanted to say minutes of settlement is a term of art, I guess, that we use. It's usually, there's other names for this document, which include separation agreement or property division agreement or support parenting and property agreement. They all mean the same thing. We call it minutes of settlement when litigation or the court process has started. Then it's generally, that's when we call it minutes of settlement, but they all mean the same thing. They all do the same thing. And when you're talking about minutes of settlement, I'm assuming you're talking whatever, the agreement that deals with the property.
Well, yeah, that agreement deals with more than just property, right? We all know that also agrees with it addresses dower rights, it addresses child support, it addresses spousal support, it addresses all the kind of the big important parts, when you go through divorce. So yeah, those essentially we have to make sure that both spouses agree. And that's what the minutes of settlement kind of outlines, is that, both people sign that they agree, because as you can imagine, nobody wants to have their name taken off of a home, and quite frankly can't be taken off of a home until they agree to be taken off. So that's the whole idea behind it. It's, protecting all parties.
Yeah. So what is the difference between what's special about the spousal buyout program? Like, I'm just thinking, okay, so what can they just refinance with a CMHC or other insured mortgage? What does a spousal buyout program, how does that affect things? Does it change the process or change how they're approved or what?
Well, it allows you to access way more of the funds inside of your home. So that's the main thing, is you're allowed to access way more equity than you would traditionally be allowed to access, because like I said, a refinance, you have to leave 20% equity inside of your home. A spousal buyout, you only have to leave 5% equity inside of your home. So
right, and I guess you can't refinance with an insured mortgage.
Correct.
Or first
yeah, because refinances are uninsurable. Yes.
Gotcha.
Yeah.
Wow,
so it actually gets structured as a purchase, Evan. Okay. So basically, if you and Kim owned a house together and were divorcing, Kim and Evan would be the sellers of the house, and if Evan, you were taking over it, you'd be the purchaser, of the home. So it's actually done as a purchase instead of a refinance.
Right.
It's pretty cool.
So for people who have never had a mortgage before, they probably, or their spouse handled the mortgage paperwork, they just were in the meeting, just kind of zoned out. They do not know what CMHC insurance is, why this protection is mandated on certain mortgages. Is there any chance you could explain that in a simple way, Krista?
Sure. So CMHC is regulated by the government of Canada for people who have less than 20% equity inside of their home. So it allows people to have home ownership despite the fact that they have limited equity. Because back in the 80s, there wasn't CMHC and you had to have 20% down in order to purchase a home. So to encourage home ownership and take the risk away from the lender, they created CMHC. So basically it's an insurance that you pay the premium on. It's a one-time premium that's added to your mortgage that essentially protects the lender to take a risk on you to be able to purchase a home. So people find that a bit confusing. You pay the premium, but it protects the lender in the event that you default.
Yeah, the way that it protects the lender is, so normally if you default on a mortgage, which was happening a lot in the 80s, yes, what would happen is the bank could seize the house, and if they sell the house and everything through foreclosure, and the house doesn't cover all of the debt and everything, well, too bad. That's you got the house. That's what you get. With CMHC or with an insured mortgage, that's not the end of the story. They can still come after the lender for whatever's left owing. So it's you have to be aware of that kind of a risk when you're doing a CMHC mortgage, and the same would apply to this spousal buyout because it's the same insurance. But that's how they take the risk away from the lender. The lender has a risk that they buy it over like overvalued, price goes down, and now the lender's stuck holding the bag. And so the insurance company takes that risk away and says, no, we'll insure that value for you. And then the insurance company will sue the borrower.
Yeah. So in the event of default, they would foreclose on the house and sell. And if there was a shortfall still, right? So the insurer would pay back the bank for the shortfall. And then the insurer would go back and attempt to sue the sellers for whatever insurance that they paid to the bank.
Okay, this is kind of blowing my mind because I didn't know this. So you pay insurance to have the insurance company sue you in the event that you default on your mortgage.
You're not alone, Heather. You're not alone.
I did not know that that's how that worked at the end of the day. Fascinating.
Yes, that is exactly how it works. And you pay the premium on it.
So you're paying the premium for the bank, basically, for the bank to insure themselves.
Yes, for the risk to take on you because you don't have 20% down. That CMHC premium goes away if you have 20% down payment.
Okay, fascinating. I didn't know that last little bit about the insurance company still being able to sue the borrower. So that is, wow.
Yeah, we get little nuggets like that on this program. You're definitely not the only one, Heather. I mean, obviously you know a lot of things about law, and so you would be classified as, someone that's a little more sophisticated about this type of thing, and you didn't know. The only reason I know is because the previous firm I worked at did a lot of real estate and gave advice on mortgages like this,
right?
And that's why I know. And so, and it was, people don't know and they should know before you do that. Before you take that.
Yeah, it's kind of like an informed consent. Like you understand that this is the way it is, but there's no way around it. Like that's the rule, right? If you have less than 20% down, you have to pay the insurance premium. In Canada, we have 3 insurers, CMHC, Sagan, and Genworth, and all 3 of them have different qualifying criteria, and that's up to your mortgage broker and your lender to find out where you fit the best box, if you will. But yeah, there's no way around it, unfortunately, unless you have 20% down.
Wow. Does that obligation go away or go down as you pay down your mortgage or as you refinance, or does it always hang out there then? Like, is a CMHC mortgage always a CMHC mortgage?
So the premium, so it's a one-time fee, Heather, and the premium reduces at every 5% interval. So for example, if you bought a house with 5% down, we would add 4% on for the CMHC fee. If you bought a house with 10% down, we would add 3.1% on to your mortgage and CMHC fee. But it's a one-time fee, so it doesn't go away. It just sits there as a one-time fee being added onto your mortgage. So it doesn't really decrease or anything like that because it was a one-time addition to your mortgage.
You bought the insurance.
Yes.
It's a one-time payment. You buy the insurance, and then the risk goes down, of course, because as you pay down your mortgage,
right,
there's less of a risk. It's going to be
right. Hopefully the housing market wouldn't tank to the extent that 30 years later you're in a default position with negative equity, but gotcha. Okay, well, fascinating. Thank you for that.
No problem.
Interesting. So I guess, go ahead, Kim.
I was going to say I have another sort of curiosity around that. So basically we have insured mortgages, so people who are putting less than 20% down, and then there's the I think we call them conventional mortgages, where people are putting 20% down. So I know in the news today they were talking about how the government was going to go back and stress test people who were in the conventional mortgage scenario. So what happens if somebody signs up for a conventional mortgage and the government, goes through their program? Is that going to potentially force people into into some kind of handcuffs if they don't meet these requirements? Or what happens if, and you might not know this because it's kind of just coming back into vogue here or up for discussion. What happens when people are maybe assessed and they're saying, you guys don't really have enough equity in your home. We're worried about the mortgage you own. So we're going to put some kind of penalty on you. What does that look like?
Okay, so there was a number of things that were brought up there. So let's talk about the stress test. Okay, so a couple of years ago, the government was worried, like you said, about basically the subprime market crisis that happened down in the States. And there was so many foreclosures, and the Canadian government was really proactive in saying, hey, we don't want that to happen here in Canada, so we're going to implement a stress test. So for example, just to give you an idea of what a stress test is, a 5-year fixed rate mortgage today is 2.04%. So that's what you would pay. However, you have to qualify at a stress test rate of 4.79%. So you qualify way higher. So in the event that your mortgage comes up for renewal in 5 years, you actually qualified at 4.79. So there's more likelihood that you are going to be able to afford your mortgage when it comes up for renewal in the event rates rise. So that makes a ton of sense. Currently, like you mentioned, there's high ratio and conventional mortgages. Both right now, high ratio and conventional mortgages qualify under a stress test of 4.79%. But what the news was today is they're thinking about making the qualifying rate for truly conventional mortgages, so ones that can't be insured, 0.5 higher. So I think they were talking, instead of 4.79, what is that, 5.29, so that you would qualify at 5.29. So basically what that would do, it would allow people less borrowing power. So they wouldn't be able to qualify for as high of a purchase price as they would have under the original stress test. So Kim, I guess the answer to your question is what would happen? They would be declined.
Right. But if they already have a mortgage,
sorry, this is too much mortgage for your income, you don't qualify under the stress test, and we would reduce the amount that they would be allowed to borrow, and we would decrease their pre-approval limit, is what would happen.
but if you have a mortgage, you're good. So maybe people thinking about divorce should speed things up so they don't
Before
See,
they
that goes faster.
You're even just thinking about divorce. Do it now. That's not generally advice that we give as lawyers. In fact, we give the opposite, or we have to.
I'm a financial advisor at Brinkman James, by the way. I think my compliance department needs me to say that out loud. So yes, I do not come from a legal perspective. I'm just thinking if people want to qualify for a mortgage, they do have to be aware of these little rules and follow the news and make sure that they are up to speed on what's happening, because things can change.
Well, I think overall, Kim, I mean, if you've been reading in the news lately, I mean, you can't not read it or hear it on the radio or on the TV. I mean, the federal government is very concerned of what's happening with housing prices right now. Like all of a sudden, we quickly had an increase in volume and an increase in housing prices. Now, here in Alberta, it's not near as bad as it is in Vancouver or in the GTA. But if you kind of read closely, it says that the federal government is watching closely as to what's happening with the housing market. So I don't doubt that there's going to be some rule changes coming up relatively quickly. If I was betting, I would bet that on April 19th, when Chrystia Freeland, our finance minister, comes out with her new budget, I would expect to see some changes to mortgage guidelines and to maybe some of the rules surrounding real estate, to come out in that budget. I kind of thought it might happen this week, but I was wrong, obviously, because it hasn't happened this week. But I do anticipate some rules coming forward to stop some of the stuff that's going on right now in the housing market.
So lots of these regulations sound like they're kind of there in a way to protect people from themselves, from overextending themselves financially. Like they're looking at people's financial situations and saying, based on what you're earning right now, we can kind of guess what you're going to earn in the future. And if mortgage rates go up too much, you're not going to be able to make these payments. So we don't want to lend you $400,000 right now. Is that kind of the way it works?
Well, lending isn't predictive. So we don't The only thing we do from a predictive standpoint is we look at your likelihood of default through your credit bureau. So if you've been late on any payments or anything like that, has a bit of a predictive behavior from a credit score standpoint. But from an income standpoint, there's no predictive nature of that at all. It's based on a past history. So typically we're using a 2-year average if you're an hourly wage earner. So we're taking your 2019 and your 2020 T4s and averaging them out. Or if you have a guaranteed salary, we'll use your guaranteed salary. Or there's no, I'm getting a raise in 6 months. Can I use that towards a mortgage? It doesn't work like that. It's based on the past, what you've proven to be viable in the past, not what you hope will happen.
They won't take my word for it that next year is going to be better.
No, they won't. I know you're good for it, Heather. You're a really good person, but no, they won't take your word for it.
Okay.
I think what Heather was getting at the predictive nature of things is the stress test.
Yes. Right.
Okay. Sorry. Yes. So they're making sure that, like you said, they're protecting people from themselves so that they, despite the fact that they want a $700,000 home, they can only afford a $300,000 home. And the stress test makes sure, that they don't buy the $700,000 home because it's too much, for their income, for sure. So protects people from themselves.
Too much risk for the collective good, I guess, is the idea, right? Because nobody cares, the government doesn't really care if one person defaults on their mortgage and has to go into foreclosure.
Right.
What they care about is financial collapse of our society and what we saw in 2008.
Yes.
Right. So you have all-time low mortgage rates right now. So that looks and truly is really affordable for folks at the moment. But as soon as those rates go up, that means your mortgage payments go up and that becomes less and less affordable.
Yeah, they're making sure that when you come up for renewal, so despite the fact that you're paying 2% now, they make sure that you can qualify. Today's qualifying rate is 4.79. They make sure when you're up for renewal that you can still afford your mortgage payment in the event that rates increase. Yes.
Okay.
Yeah, I do think that there'll be some changes to because household and consumer debt in Canada is staggeringly high of how much debt people carry. I do anticipate there'll be some changes to the home equity line of credit rules that are going to come into play, I would think, relatively soon as well.
And you mean the ratio, the 65% ratio? I think is that what it is?
Potentially, but what I've been reading, because I said I'm a bit of a geek and I read all of these economist reports and stuff like that, the word on the street is not allowing, so right now you can use your home equity line of credit, so the money sitting on your home equity line of credit as a down payment for a new purchase. And they're not wanting that to happen moving forward because people are far too leveraged at this point in time.
What is the ratio right now? What is our borrowing rate? How over borrowed are we in Canada?
I haven't checked recently. Evan, does anybody know that? Kim, off the top of your head?
I think it was 1.7 something the last time I looked.
I was just going to say the same thing. 1.7% for every dollar you owe 1.7%.
Ooh.
It's a lot.
It's getting pretty close to
that brings up a question about bankruptcy and consumer proposals. If you have one of those things, like we know Canadians are highly levered and there's a lot of personal debt. Many people out there have a consumer proposal of bankruptcy under their name. What does that do when it comes time to divorce and they need to buy property?
They don't. They rent. That's taken very seriously in the lending world. Consumer proposals and bankruptcies are viewed fairly similar to each other. So essentially, the rule is if you've had a bankruptcy or a consumer proposal, it has to be discharged. It has to be at least 2 years post-discharge, and you have 0% tolerance of having any further late payments. So if you've had a bankruptcy and then you're late on your cell phone bill, too bad. so sad. Like you had an opportunity to fix your ways after you went bankrupt. They expect you to be perfect after that. So if you've been in that situation, and lots of times bad things happen to good people. I don't want to paint everybody who has had that situation that they're a bad person, because they're not. But it is taken seriously. And like I said, 2 years post-discharge, and then you certainly wouldn't be allowed gifted down payment either. They would want you to see you save some money, have some skin in the game, stuff like that. It's certainly harder after bankruptcy, like for sure harder.
I'm glad you're talking
about that. And it should be, quite honestly, I don't think it should be easy to be able to obtain. Homeownership is a privilege, not a right. That's the way I see it. And if you've made mistakes in the past, you kind of have to prove yourself worthy.
I'm glad you're talking about that, because a lot of times people in tough situations, debt-wise, may be tempted to feel like bankruptcy is like a get out of jail free card. Get a fresh start. And I mean, that is kind of the point of bankruptcy laws. And so I understand why they start thinking that way, but there's more consequences, lasting consequences from what I'm hearing you say, and just, you don't have to pay all that debt back.
Yeah, so especially if you lose a home during a bankruptcy, so if they foreclose on your home during bankruptcy, the likelihood of ever getting a mortgage again is very minimal. Because if you've, of course, like if you borrowed your friend $100 and then they didn't pay you back, would you borrow them money again? No, it's the exact same situation. If you bank borrows you hundreds of thousands of dollars and then you don't pay it back, is the next bank going to borrow you hundreds of thousands of dollars? Probably not. Your, behavior hasn't, you don't have a really good track record when it comes to stuff like that, right? So,
that brings up a really important question. Where are you from, Krista?
Here, Alberta.
Interesting, because I've never heard, some people use the word borrow for the word lend. And I just haven't heard that a lot here. So one of my backgrounds is I did a linguistics degree. So these types of things I find really interesting, like dialectal variants. And so like in England, they'll say, they'll use learn as a verb, like instead of teach. Oh. Like he learned me, and like straight, that is, in some places in England, in some dialects, that is accepted. That's normal. Here, you don't sound, learned if you use learn to mean teach here in Canada, but borrow as lend. I found that a very interesting use of the word borrow.
There we go. Okay.
Higher intellect.
Yeah.
Thanks, Kim.
Kim, do you have anything else you can add to like the dire consequences or the challenges that somebody who's been through bankruptcy will face?
So I only recently learned about an R rating and what an R rating will do to you and what levels there are. So if you don't pay a bill, you get a rating. And I only just recently learned about this. So I'm assuming a lot of people don't know about this. And what are the really bad things to do versus like the somewhat okay? Like if I let my overdraft kick in on my checkings account, does that give me an R rating? Or does it not? And what are the things that people should be careful about when they're paying bills? I'm curious to hear your thoughts on that, Krista, because I don't have a lot of knowledge on this.
Yeah, so the R rating you're talking about refers to revolving. So when I look at a credit bureau, it's probably Greek to most people because it's a bunch of lines and numbers and all sorts of stuff. So it's kind of like coding language, but for lending. So basically what happens is, if your cell phone's reporting to your credit bureau, which it does, and your credit card and your mortgage and all of these things report to your credit bureau, an R1 means you're paying on time. It means that everything's, you get the bill, you pay within a allotted time frame. If it goes R2, it means you're 30 days late. If it goes R3, you're 60 days late. R4, 90 days late. R5, they're often registering a collection. R9 means that it's gone for collection, and then you'll actually see a notice of public interest, that there's been a collection administered on a credit bureau. So it's really important that you pay on time. So if you find yourself in a situation that, maybe you've got a credit card bill or something like that, and I strongly recommend paying off your credit card every single month, because credit card interest is incredibly hard to get out from behind. But let's say you had a tough month and you couldn't, at least make your minimum payment on time. That's the key there. So make the minimum payment on time, and then of course interest will start accumulating, but that will stop. If you make a zero payment, then it's going to go R2 on your credit rating, and that's going to start lowering your credit score. So the R ratings are your ability to pay on time. So it's important that anything that reports to your credit bureau gets paid on time. And most things actually, I shouldn't say most things, anything that's a credit facility. So a car loan, a credit card, a line of credit, your cell phone, those all report to your credit bureau. Things that don't report to your credit bureau are like your car insurance or your utilities. Those don't report to your credit bureau. So although the utilities in your house are relatively important, you don't really want those shut off. But if you're more concerned about your credit rating, I guess I'm not telling you where to default.
Sacrifice those for the cell phone? Put on a sweater. Your cell phone reports to the credit bureau. Don't screw that up. Put on your sweater and light a candle.
Your heat might get shut off, but you can talk on your cell phone. Sorry, that's so wrong on so many levels.
When it comes to qualifying for a mortgage, then, the lenders look at the credit score, and then, as I understand it, there's like the 5 C's. This is all through textbooks I've done on the financial planning side. So what is really bad? What do we not want to see, and what do we not want to do, and how do we fix our credit score?
So the 2 major components of your credit score are how much you're borrowing and how timely you are in paying back. So 35% of your score goes towards your timeliness. So making your minimum payment on time. So that's critical in improving your credit score, is paying on time. The second largest, or I guess of equivalent of importance, is how much you're borrowing. So 35% of your score goes towards how much you're borrowing. So I strongly recommend that if you have a credit limit of, let's say, $5,000 on your credit score, if you have $5,000 limit on your credit card, you don't max out that credit card, because you're using all of your available credit. You really want to make sure your balances are at least 50% of your limit. So again, I strongly recommend that you pay off your balances in full every single month. But in the event that you can't, keep your limits at least 50%. Keep your balances at least 50% of your limit, and that will keep your credit score revolving high. Does that make sense?
That's really interesting.
Yeah, it's good to know.
Are spouses' credit scores tied to one another's? Do you need to worry about your ex's credit score in the event of a separation if you're going to try and qualify for any kind of lending?
So if you're financially tied, yes. So let's say that you have a joint car loan or a credit card with a supplementary card for your spouse. Those are tied together financially. So if your ex takes over the car, but your name's on it, and then defaults on the car payment, yes, that'll report as an R2 or an R3 on your credit bureau. And whenever you have a mortgage application and there's a late payment, they ask, what happened? Why is this R2? Why is this R3? Why did this go to collection? So I have to explain any default that's sitting on a credit bureau. So that's why I think it's really important, Heather, that we divide and don't keep people tied together financially, because it can really affect the other person if they keep joint trade lines together.
Okay, that's good to know.
But Krista, so if your starter husband was terrible with paying his bills, and
hypothetically.
Yeah, no, not your actual starter husband. We don't want to say anything bad about him. But your, as in, somebody's starter husband.
Okay.
is terrible with finances, but they don't have any joint credit cards or joint loans or anything like that, then there's no effect on each other's credit? Okay.
Yeah. Unless there's a joint mortgage, of course.
Right.
So,
but if the mortgage is in good standing, if the joint mortgage is in good standing, then starter husband can be terrible with the other stuff and you're still fine.
Correct.
Okay.
Yes. Yeah, you won't be tied to them if you don't have joint. Because when you pull a credit bureau, it's based on your social insurance number, your birth date, and your name. So it's not tied to them in any way because your social insurance number isn't attached to their social insurance number.
It doesn't know who you're married to.
It does not know who you're married to.
It just knows who you have joint debts with.
Yes. And often we see joint debts that aren't necessarily a spouse.
Right.
So for example, if a parent, co-signs a car loan, it just says J on the credit bureau, but it doesn't say who it's joint with. So it isn't necessarily a spouse is all I'm saying.
Gotcha. Oh, that's good to know as well.
So for pre-planning our divorces, and we've been linked to our spouse, joint accounts, everything, what are your suggestions in terms of how somebody should start to set up their banking situation? Because I know that a line of credit plays a part in the ratio on your calculating your mortgage. So would we be doing somebody a disservice saying you should set up your own bank accounts, get your own line of credit, all this kind of stuff? So what's your take on that?
Well, financial independence is important. So set it up without having a co-borrower, set it up independently on your own. Good idea to have your own bank account, to have that kind of, because if you're purchasing a new home, so if you're not doing a spousal buyout, if you're purchasing a new home, the lender is going to ask to see a 90-day history of your down payment funds. So if you've got money sitting in a savings account, you want that in your own name, for the previous 90 days. So that's a good idea. From a line of credit standpoint, that's actually a bit of a tricky one, Kim, because it's evolving today as we speak. So typically the way it used to be, as in 2 weeks ago, if you had a line of credit that had a limit of, let's say, $20,000 and you owed zero on it, it wouldn't affect your debt servicing calculations at all. It would just be available credit for you. But recently, the lenders have been saying, we are going to pretend that this line of credit is fully advanced at $20,000. And the rule with that is despite your payment is interest only, so that might only be $50 or $60 or $100. From a lending standpoint, you actually have to qualify at 3% of the limit. So 3% of the limit of the line of credit, ends up being quite a significant payment. It's not interest only. So it does become difficult to qualify for a mortgage if you have a large line of credit. Again, it's a bit of a moving target right now because those guidelines are changing with COVID. If the balance was zero before, it didn't affect you. But now a lot of the lenders are saying you have access to $20,000. We're pretending that the $20,000 is, borrowed out.
Huh.
Oh, that was going to be my next question was, what about available credit? So you've answered the question about line of credit, which that's got to be annoying to people that are just learning that. What about credit cards?
Yeah, we haven't seen them doing that on credit cards. So if you have only $1,000 owing and you have a $25,000 limit, typically it's just you use whatever the balance is that's currently owing, not the limit. It's the lines of credit of our particular concern.
I'm wondering why that is, because obviously credit cards way higher interest. Is it because they're thinking, well, because it's higher interest, you're less likely to run that up than a line of credit, which has usually lower credit or interest? Why are they attacking line of credits?
Yeah, that's interesting.
Maybe it's a larger pool that typically could be advanced on the line of credit.
Well, I think, and maybe it's because it's cost-effective borrowing, right? So if you cash advance a credit card,
Yeah.
You're literally paying 20% interest. If you withdraw cash off of your line of credit, you're paying likely, if it's a home equity line of credit, you're paying prime plus a half. You're paying,
Right.
3.5%, versus 20%. So I think less people are unlikely to cash advance their credit card on a large dollar amount. However, that being said, I wouldn't be shocked if, there are the odd people that have very large limits on their credit card. Not typically, but there are a few that have like a 50,000, or greater limit on their credit card. It wouldn't shock me in today's COVID lending world that they would say, we're going to pretend that this is fully advanced. Despite that the rule is written one way, that doesn't mean that they're actually following that from a guideline perspective. They are being a lot more cautious with borrowing these days.
That's interesting because the banks do seem to want to lend money as well, right? Like, I don't know about you, but I often get like, oh, we're going to increase your credit card limit. You get those once or twice a year and they're constantly bumping it up. So that's interesting. People maybe want to think about that when they're offered that kind of credit increase from their banks.
Yeah, for sure. And there's, in the last probably 5 years, there's been significant changes to the rules, surrounding that stuff. Is like, remember you used to get you're pre-approved, in the mail, and it would have like your name, address, and birth date and everything written right on it, for the mail fraudster to steal it. I think there's some rules now that say like they can only offer an increase, ever so often, and only to Heather, you clearly have good credit, because they don't offer it to folks who are struggling and are at their limit. They're offering it to the people who don't owe anything.
Okay, right. Okay. That is interesting. So what if you don't have much of a credit history? Like, are there things you can do to build one up that, if you don't have a huge income or you don't have a lot of assets, to build up a bit of a credit history?
Yeah, actually, that's a great question. I mean, I have an 18 and 19-year-old kid. So right now I'm sitting with them saying, hey, it's time to start building your credit history, because mom doesn't want to have to co-sign for you forever. One of the things, like cell phone, putting your cell phone in your own personal name, if you're establishing credit, is a great start. So get your kids off of your cell phone plan and put them on their own cell phone plan. That's a great place to start in establishing credit. Student lines of credit report to the credit bureau. So that's another great place to start, or getting a small loan or even a secured credit card. Capital One has a secured credit card where you give them $500. And then they offer you a credit card for $500, and then it's your job to manage it and, pay it on time, and they've got your money in the event that you screw up. But it's a great place to start. From a mortgage standpoint, a lender is looking for a minimum of 2 different revolving trade facilities, and they're looking for about $2,500 worth of revolving credit. So it does take a little bit of effort to get your credit established, but you got to start somewhere. So get a credit card, if it needs a cosigner in the beginning. Typically, if you manage it well for a year, then you can typically take the cosigner off. Get that cell phone in your name, start with a small loan, even if you don't need the money. Just get a small loan, like a $5,000 loan, and leave the money sitting in your savings account and pay it back every single month to start establishing credit. Do anything along those lines, because credit is really important. Credit's kind of what makes the world go round. When you're looking to, buy a home or buy a vehicle or an RV or whatever you're wanting to do, credit's important.
I like how this is kind of turning into like tips for a good credit score with Krista, because it's good information to have. I'm like, everyone, like you said, credit makes the world go round. And it's especially important if you have good planning about that, about your credit, then that's not going to hurt you if you unhappily happen to be going through a divorce. That'll be an asset for you. So if you do, to go back a second to the when we're talking about having credit cards and lines of credit, available credit hurting you when you go for a mortgage, obviously it's easy to close an account. You just close it. You can, if there's no balance, you can close it without an issue. Is it a challenge generally to roll back like credit limits on both credit cards and lines of credit? Do you know?
Well, typically we don't see people rolling back limits. We see them converting them into a loan. Because that 3% rule that I just told you about, if you have a $20,000 line of credit, all of a sudden we have to debt service a payment of $600 opposed to the interest only payment of $60. However, if you convert that into a loan, then you have a fixed payment of, let's say, $130 every, 2 weeks or whatever it is. So yeah, I am sure if you asked, they would probably lower your limit on something. You just need to ask. But, from a qualification standpoint, it typically is, converting it to get it paid back faster. Home lines of credit are really difficult for a lot of people. It's one of the areas that people struggle the most. I probably get a phone call at least once a month saying, take my home equity line of credit away. Like, this is a bad thing for us. We struggle with this. As soon as we can't pay off our credit card, we just plunk it on the home equity line of credit. Oh, we really want a quad. We'll put it on the line of credit and we'll just make monthly payments. But people are not disciplined enough, or a lot of people aren't disciplined enough. It's a big area of struggle for a lot of people. And I think that's why the bank is cracking down, and lending is cracking down on those lines of credit, because they are a struggle for a lot of Canadians.
It's too tempting to have access to that money sitting there. It's
money available and it's cheap.
Krista, 2 weeks ago, I was on a webinar. I thought it was going to be about something else. Anyways, I ended up on this webinar and it was all about consolidation loans, which I didn't know much about. So I stuck with it and listened through this thing. And it sounded, the fellow doing the presentation, it was in cahoots with MNP. And it sounded like their shop was specializing in consolidation loans. Is that a thing, or could somebody come to you for consolidation of their debts? Because we know in divorce there's scenarios where people are just dividing debts and they end up with a chunk on their own. How does that work for somebody trying to clean up a bunch of little pockets of loans?
Okay. So if it's matrimonial debt and they're taking over the home, we can include it. Right? If there's still a house involved, I can't do any lending unless it's attached to a home. It's securitized. So that's the only way that I can help out with that, is if we're including it in the division of matrimonial property. However, when you said MNP, that kind of got the hairs on the back of my neck kind of standing up, because that to me is a bankruptcy or consumer proposal trustee type situation. Is that what it was?
Yeah, their insolvency department was just part of this discussion on what it looks like to consolidate loans. Because a lot of people have loans all over, and there is a scenario where you can pool them together for a better rate. And I think MNP they were mostly just listening in, but they had this specialized lender in giving us different scenarios about what it looks like to consolidate loans versus what it looks like not to consolidate loans.
Well, consolidation is a fantastic tool to wrap all of these payments up into one. So it makes it a little bit more manageable. I would say with extreme caution to really check out the source where you're getting that consolidation loan. Because, you hear these advertisements from money mentors and stuff like that on the radio. Those actually register on your credit bureau, like from an insolvency standpoint. And again, it's like ruining your credit for the next 2 years. And that stuff stays on your credit bureau, like it reports for another 6 to 7 years. So if you need a consolidation loan, I strongly recommend that you talk to your bank before you go see some sort of trustee, or even calling those money mentors. I mean, I just don't love the concept of, I like the concept of consolidating. I just think you need to be really, really careful where you go. Does that make sense? Because you don't want that further. It's one thing to get a consolidation loan from a bank where they pay out your 3 credit cards and have 1 loan payment. That reports normally on your credit bureau. If you are going to any sort of trustee or debt consolidator, it can report as like R5 on your credit bureau, and it's registered that you've seen a debt consolidator. Well, can you imagine how hard it is to get a mortgage once you've got debt consolidation written onto your credit bureau? And it's going to stay there for a long time. So I just proceed with a lot of caution if you find yourself in that situation.
I think that's a really important thing to know. I think nobody knows that. I'm just guessing, but I didn't know that, and I end up on lending webinars, right? So
Krista, you just dropping the truth bombs left, right, center.
Amazing.
I teach, I think of this from a mom perspective. Who teaches kids about credit? If you're a crappy money manager, who teaches your kids about money? Right? So I find myself, gathering knowledge in this area, and I volunteer at the local high school to go in and teach kids about credit. Because if you don't have a family that teaches you about this kind of stuff, or you were raised by parents who were not really good with managing money, where do you even learn? Yeah. Where do you learn from?
Well, don't worry, the government's going to teach us now. Which, I mean, I'm saying that to poke fun, but I think that's great. That's a step in the right direction. That's now going to be part of like the standard curriculum, that they learn something about money. Yeah. But it's such a great point, Krista, because financial education is and financial literacy is something that people don't know about. Like, why did I have to learn all these things that I know about finances, what I do know, as an adult? Why didn't I learn them younger? I don't know. So, yeah, listen to this podcast and you'll learn all kinds of things.
Yeah, we're going to have you back, because I have 1,000 more questions for you that are they're coming out of this. But
I'm happy to brain dump on you all.
Yeah, well, I guess it looks like we're wrapping up. I just wanted to say for the record that I was not trying to say anything negative about your idiolect, your dialect of how you were using borrowing. No, so I just want to make that clear for the record, because, some people can listen to it and think like, what a jerk. What is he saying about her? And no, it was not meant anything like that. So,
you know what, Evan? Sometimes people ask me if I'm American.
Really?
Yeah. So I maybe just talk a little different than most folks. I'm not sure. But I'm not easily offended, and I wasn't offended by your comment. So we're good.
Good, because it was definitely not meant to be offensive. And I certainly have valued all of the stuff that you've shared. I've learned a lot from this session.
Perfect.
Yeah, it's been so fantastic and very helpful. Thank you so much for coming on and sharing your knowledge with us, Krista.
Yeah. I'm happy to pass it on. Of course, if anybody has mortgage-related questions or even credit-related questions, I'm certainly available to answer any questions that people have. I think you need to find a resource, right? A resource that can be trusted and can be a straight shooter. I value honesty, and whether I think something's going to be good or bad for you, I'll tell you. That's a good choice, or I would consider maybe not doing that.
Yeah, well, drop your contact details right here. Tell it, how can people get a hold of you?
Oh, okay, sure. Can I duck?
I love it.
My website is Mortgage Simple, not Mortgages Made Simple. So my website is mortgagesimple.ca. Email is Krista@mortgagesimple.ca. Krista's Krista. And my phone number, 780-946-6222, if you need any help with that stuff.
That's great, because some people will be listening to this just on the podcast. So hearing those details is helpful. So
I have one more question. Can people from other provinces reach out to you? I accidentally gave a referral to you last week, but it was somebody in a different province. And then
it's okay.
That's okay. Okay.
So I have my mortgage brokering license is based out of Alberta, but I have additional jurisdiction because I'm oh my God, I don't even remember my designation. Canadian mortgage professional. So I'm accredited across Canada. So providing the majority of my business is done in Alberta, I can do business and do business all across Canada, with the exception of the province of Quebec.
They're always special.
No comment.
I don't think they even call it a mortgage, right?
I don't know. What do they call it?
Hypothec or something.
Hypothec.
Yeah, there you go.
Oh, I didn't even know that. I just learned something today from you guys.
Yo.
That's what we're all about.
Yeah, learning.
Yeah. Thank you so much, Krista.
No problem. Thanks for your time, guys.
Any information in this video is general information only and is not, nor is it intended to be, legal advice. Watching this video does not create a lawyer-client relationship. You should always seek the advice of a lawyer or other qualified professional for advice regarding your individual situation. While we take care to ensure that the information contained in this video is accurate and up to date, we make no warranties or representations as to the suitability, completeness, or accuracy of the information contained in this video. Any reliance you place on the information is at your own risk. Kahane Law Office, Merrick Law, Heather Malarick Professional Corporation, Evan Clark Professional Corporation, Evan Clark, Heather Malarick, and any guests will not be responsible nor liable in any way for any content, including but not limited to any errors or omissions in the content, or for any loss or damage of any kind incurred as a result of any content communicated in this video, whether by Evan Clark, Heather Malarick, or by a third party. Kim McDonald is a financial advisor with Raymond James Limited. Information provided is not a solicitation, and although obtained from sources considered reliable, is not guaranteed. The view and opinions contained in this media are those of Kim McDonald, not Raymond James Limited. Securities-related products and services are offered through Raymond James Limited, member Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member Canadian Investor Protection Fund. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters.
Stole my heart from my lips. That was it.